Welcome, ladies and gentlemen, and a good afternoon to you all. We're here for the Schroder UK Mid Cap Fund investor presentation. This presentation is being hosted on Research Tree by Doceo and Capital Access Group. As we proceed with this recorded session, investors will be in listen-only mode. We strongly encourage questions, which you can submit at any time through the Q&A tab on the right-hand corner of your screen. Simply enter your question and press send. If you would like to leave feedback, please hold on at the end of the session and there will be a short survey you can fill in. While the company may not respond to every question during the meeting itself, be assured that management will review all questions, where appropriate, publish responses. You'll find these responses on the event page on Research Tree. So without further ado, I'd like to pass the baton to Jean Roche, co-manager of the Schroder UK Mid Cap Fund. Jean, a very good afternoon to you.
Good afternoon, and good afternoon to all who are watching, who have taken time out from their tennis watching or whatever else they might otherwise be doing this afternoon to listen to this webinar. As Alex said, it'd be good if it was interactive, and I'd be happy to hear your questions. I did a similar session, but with 3 other fund managers on UK equities last week in the LSE, and there was obviously a lot more energy in the room because there were a lot more people in the room and we had the audience, so I could see their reactions. So I'll do my best on this sort of format. To recreate some of the energy and the excitement that we see in UK equities and in UK mid-cap equities in particular. Now, last Thursday was particularly exciting as well because it was the interim results of Schroder UK Mid-Cap Fund PLC, and I'm the lead manager on that fund since 2021. And I've been involved in the product for getting on for nearly 8 years now. The fund's been around, though, for 20 years, and it is the top performer in the all companies sector of the investment trust segment in the UK. Now, certain trusts have fallen by the wayside in the meantime, but it's still a tradition that I'm proud to be carrying on. Some of you might be familiar with some of the rest of the team. Andy Brough has been there since the beginning, since Schroder's took over on this trust in 2003. And I mentioned that I've been involved in the product for the last 8 years. And then we had James Goodman join us last year, which adds a lot of additional analytical firepower. And we also have Ian Staples on the team, who's also a very accomplished fund manager in his own right. So a good bench, over 90 years of investment experience and building it as we go. So why do we like mid caps, and why do we like UK mid caps in particular? And the mid 250, as you all know, is the FTSE 250, which is the next 250 companies by market cap under the FTSE 100, excluding investment trusts. And now that's a universe now of 170 stocks. So what could be easier than picking around 50 of those and watching the returns rise? Well, we do like the index and call it the Heineken index. And I've been told this might now be a bit dated because not everyone remembers the Heineken advertisement, but it refreshes the parts that others can't reach. And it's what we mean by saying we call it the Heineken index is that it's constantly refreshed. So we see in this index many IPOs, many take privates, promotions to the FTSE 100, and of course relegations into the small cap, as well as promotions from the small cap into the FTSE 250, which is quite an interesting place to look at companies, and then promotions back into the FTSE 100 as well. So a lot of moving parts, and I think we remember a quarter where there might have been in excess of 30 moves, and I think that was probably around the 08 or 09 time. So exciting times in the index, and a very dynamic set of stocks to pick from. And then we have what we've identified 89 different themes actually among those 170 companies, and that they're all in different niches, some high growth, some not, but it means that you can tilt the portfolio towards or away from certain growth or more sort of stable types of aspects of the economy. Then you have sustainable, well-covered dividend payouts. What do we mean by that? Well, just to give you an idea, in the portfolio itself, we have a dividends covered on a median of 2.2 times. But this tends to be an index where companies don't overextend themselves because people aren't really buying these stocks for the dividend. So they're able to pay well-covered dividends and actually able to often buy back shares as well, and build cash and invest in themselves in many cases as well. And there are many examples of that in the portfolio. I could call out examples like Telecom Plus and Cranswick, for example. Telecom Plus being a multi-utility company, and Cranswick, which makes sausages, bacon, and the McCrispy chicken burger. But so some very interesting business models, and able to make very good dividend payouts, although that's not the focus of what we do. We say there's a clear sell signal on promotion to the FTSE 100. What do we mean by that? Well, we're seeing over the years, we've seen that if we sell when a stock goes into the FTSE 100 and reinvest and look maybe further down the mid 250, maybe in those bottom two quartiles, that's where we're seeing some very strong returns. And so for us, what you're getting is a pure mid-cap product. And we think that there are very few other indices which have that sell signal, actually. So for us, that's one of the attractions of the mid 250, that we feel that the stock's becoming better known. There are more analysts covering it, and thus less alpha to be discovered by owning the stock. So for us, that's a clear sell signal. We see a very different sector exposure relative to the FTSE 100 as well, and nowhere was that more strongly felt when it's all about commodities, all about banks. And the FTSE 100 was performing very, very strongly. But you've got a very sort of concentrated pharma, banks, commodities, and the odd large tobacco in the FTSE 100, whereas you've got far more options of different sub-themes in the mid 250. And then finally, the mid 250 very much seen as a UK domestic proxy. But actually, when we have a little look closer, we can see that half the revenues of this index, of the companies in the index, are actually from outside the UK. And of course, therefore, half are inside the UK. So you can very much flex the portfolio however you wish, towards or away from that. But if you combine all of these factors together, what you end up with is an index which has actually outperformed the majority, or actually most major developed market indices. And we have a slide showing that shortly. But I think what we wanted to mention first was what I sometimes call this the slide of doom, because as soon as you put a company up here, you can be sure that there's going to be some sort of bad news. But last time I checked, today we were all right. But these are examples of companies. So what we're trying to do actually is buy the FTSE 100 companies of the future, and we see the mid 250 as, to some extent, a bit of an incubator for those companies. So companies like Games Workshop, some of you may be familiar with, like Man Group, which is analyzing billions of pieces of data and then managing people's money and building portfolios in that way, and has bought back 25% of its own market cap over the last 6 years in terms of share buybacks. So one of those highly cash generative models. Telecom Plus, saving UK households 30 million in their energy bills last year alone, only 3% of the market, but growing the top line in excess of 20%, and paying significant dividends at the same time, pushing into other utility areas as well, such as insurance. And then Spectrus as well, saving cash on processing for companies, and also has gone through a very interesting restructuring, and has been able to buy back shares and deliver cash returns to shareholders. So and very much involved in areas such as pharmaceuticals and automotive, and some very vibrant parts of the UK and international economy. And why would you invest in the mid 250? Well, this is just giving you a picture of what the trust has done since Schroder's took over management in, as I said, in 2003. So you've had the dividend increase tenfold in that time, so 10 bagger, 13.3% per annum to be exact. And actually, and you can see through various stages, the global financial crisis, the Brexit vote, the COVID pandemic, the war in Ukraine, and actually more recently, we're flirting with a global recession as well, and the fund has continued to perform, and the dividends have continued to be paid. And when we announced our interim results last Thursday, and I think there's a link in the handout section to the interim results, you could see that the directors have announced a 10% increase in the dividend for the half year from 5p to 5.5p. So that dividend went from 2p all the way up to 19.5p, which was the 2022 September year-end dividend. And now we're seeing another 10% for the start of this year, the first half of this year. And we were very happy to announce in excess of 3% outperformance of the benchmark as well in the first half of the year. So myself and my co-manager, Andy Bruff, were very pleased because we're also shareholders in the fund. And I think people do like to hear that fund managers are shareholders in their own funds. So you've got that with this as well. But if you look at, why have we put in the pint of beer price, the pint of milk price and house prices? Well, I think you're seeing that the fund is delivering its own dividend, is beating inflation, even where inflation has been recently, has been solidly beating inflation over the several years. And if you compare that with what house prices, beer and milk have done, house prices have only doubled in that period. Milk, again, doubled despite recent significant increases, only doubled in that time. And beer kind of getting on for tripled its price. But, I think if you're looking for an inflation hedge, you're seeing, you'll see that in the dividend. And the dividend is just a side product, of course, of the philosophy and the process in this fund. It just happens to be that the kind of companies we invest in do pay out significant amount of cash because are able to invest in organic growth as well as M&A also. So this is just what happens when you invest in companies which are very cash generative. I talked earlier about the opportunities within mid caps in terms of the sector exposure. So this is just showing you a bit more detail. You've got a great big universe of industrials, for example, in the FTSE 250. Quite interestingly, you've got a higher technology exposure actually in the mid 250 as well, or FTSE 250 ex investment trusts, 5%, whereas you've only got 1% in the FTSE 100. So you can see there in the FTSE 100 the consumer staples, the consumer, the financials, and the healthcare being very big parts of that index. And I think you can see that you're getting more of a menu to choose from and more exposure to different parts of the economy through the mid 250. So a different collection of opportunities, as it says there, to the large caps. One other reason I talked about the index being refreshed like no other, and I think you can just see that here in this graph, and that what that is showing you is those sort of lime green bars, the percentage of the index that gets acquired every year. And of course, last year we were looking at sort of 80% premia, many trade buyers. This year a bit more private equity, certainly in the first quarter of the year. But you're seeing premium more like 30-40% this year. I think it all kind of depends where the valuation is relative to its history as well in terms of the premium you get. But generally you're getting around a 40% premium. So you're seeing that contribute to the returns in the index, and obviously if the fund owns the stocks, then the fund's returns are enhanced as well. Relative to, say, if you're buying FTSE 100, you might be waiting a long time before you were getting, say, 6% or 5% of the index bought in any 1 year. If you see that, that's the blue line there. And then the purple line is small cap. And again, they tend to be bite size. Again, they're more likely to be acquired as well than the very large cap. But the point really is to focus on that green line, and that's a significant amount of the index purchased every year. And we can talk separately about whether that's a good thing or not. But the fact is it adds to returns, and you do see companies coming in to replace those companies, their places in the index. Now, when we were doing some work on the fantastic performance of the Mid 250 index, and I mentioned it's performed all other developed markets over the last 25 years, we actually did some work on the 30-year anniversary of the FTSE 250 index. And we actually saw there that when we were looking for multi-bagger stocks, and of course that's a term coined by Peter Lynch and something that we've had our own podcast on. And if you look up Schroder's multi-baggers, Jean Roach and my colleague James Goodman, you'll find that podcast. But what we are finding is that the UK, there's more of a probability of finding a multi-bagger and actually a 30-bagger for the 30-year anniversary of the Mid 250 in the UK than there is in the US. So what we did was we looked at the amount of stocks that have been quoted over the last 30 years. We looked at the ones with 30 times their return. So that's 29,000% return over the 30 years. And then we looked at what percentage of the stocks, what percentage they represented of the entire stocks you could have invested. So that had to be an investable universe. It couldn't be a stock that traded, one stock a day. It had to be possible to get them into a portfolio. So a certain minimum market capitalization. So we came up with 4.3% of US stocks returning a 30x return, but you had 5%, the UK beating the US quite comfortably with 5% of those stocks returning in excess of 30x. And which stocks were they? I think you might, we were all very curious to see which stocks those were. Actually, we saw, and this was we were talking at the LSE last December, and actually that's online as well. But we did the date, it's the end of November, but we've cut it more recently as well. And what kinds of stocks were actually featuring. So here we have the stocks. They're all previous or current holdings in the trust, and HomeServe's actually been acquired now, for example. So that's not in there, but and Ashtead is in the FTSE 100. But these are all stocks that have returned in excess of 30 times over 30 years to the end of November. And things have obviously moved around a little bit since then. For some of the more real estate focused plays, that say Granger and Savills, they mightn't be 30 baggers anymore, but they're certainly still multi baggers. And it's quite interesting that you can see that there is a proliferation of these in the mid cap world. And as I said, that the UK also beats the US in terms of probability of finding one of these multi baggers. And so there you can see, now that's in local currency for each, but you can see that that green line there is the FTSE 250 excluding investment trusts. Below it is the S&P 500. So the FTSE 250 is beaten the S&P 500, and you've got Euro stocks and the FTSE 100 at the bottom there, which is very interesting given that the UK stock market actually outperformed all other global markets in 2022, for example. And yet the FTSE 100 still sitting down there in the long term, not returning anywhere near as like what the mid 250 can do. So that's where we do quite like to. This is why we like to sell when stocks go into the FTSE 100 and look then for the next opportunity. Now, if we look at this graph, and it has to be said in dollars, the S&P will just pip the FTSE 250, the mid 250. But I think, it's really certainly quite surprising that it is neck and neck with the S&P 500 over 25 years on a total return basis. And we do have the graph in dollars as well. But this just highlights the local currency. So if you're investing in pounds in the UK, this is what you would see in terms of that green line. So onto the fund. If you look on your screen, the ticker for it is SCPLN if you have Bloomberg, and you'll see what it was before I came from my desk just now. The share price of the fund is 538p, and that is a discount of 14%. I think it's showing 14.9 there, but just before I came on air, the discount was 14% to the net asset value, which was published this morning of 624p. Obviously, that net asset value would have been cut yesterday. So, I think you would say, when you see a discount like that, is that performance driven? But I think you can see from that, and that's performance data to the end of May, looking a bit better to the end of June on the 1 year basis, and still well above the underlying index on the 3, 5 and 10 years. So we're actually seeing long-term outperformance, and as I mentioned, the trust is the best performing in its sector since inception. So we don't feel that the discount was, you could take it personally, but we don't feel that the discount is related to what we're doing with the fund itself. I think it's just very much the negativity around the UK in general, and despite the fact that the UK has actually been outperforming most other and all other markets in 2022. And I think, you could see it as just fear of getting caught out, but actually what the companies are reporting, and that's the slide I have to show for compliance purposes. What the companies are reporting actually is, a lot of them are beating expectations, raising expectations, saying that their results are going to be better than expected, and paying out dividends high growth in dividends, well covered dividends, doing multiple share buybacks. Maybe 17 of the 50 holdings we have in the portfolio are doing share buybacks at the moment on top of dividends, or they're doing deals. And many, I could name, sort of, I've mentioned Telecom Plus growing in excess of 25%, but you've also got companies like Diploma, which is an industrial distributor, and you've got simple retailers like Dunelm growing the top line double digit as well, and just being the best in their category. So you're seeing best in class, and some of those multi-baggers, really best in class companies, best in class management at a discount and reporting solid results. And you're seeing that discount, that premium to FTSE 100 has fallen away very considerably. And you can see there that the FTSE, the mid 250 is on 12.1 times. And actually, this is just updated to the end of May. That's actually compressed more towards 11 times. So sitting right at the bottom, this is just a PE, calendar year 23 PE. And very, pretty much where the small caps are as well. And you can see there that Russell 2000 heading off into 25.2 times earnings. So I think for a margin of error, the valuation is looking very attractive. And if it's all about the price you buy something at, then I think it's well worth considering exposure to the UK mid cap universe. So I talked about the mid cap universe. You probably want to know how we characterize stocks and how we choose stocks for our portfolio. And we split the universe of 170 stocks into 3 categories: unique stocks, flex stocks, and stocks to avoid. I should probably deal with the stocks to avoid first, probably the title, the clues in the name there. Generally, it's companies where we see shareholder returns being destroyed. It can be often in sectors where there's industry over capacity. There can be significant accounting concerns, and we will just classify a certain number of stocks in that way. But more happily, and being more positive, I've been talking about the positive qualities of UK mid caps. We see the vast majority of stocks as being either unique or flex. And by unique, I mean it's the only way to get exposure to that investment theme is by investing in that stock. And I would say that's a stock perhaps like Games Workshop, which I'll talk about in a little while, where you've got small miniature armies, which you paint with paint that only Games Workshop sells, which each has their own characteristic, and you play table strategy games with the pieces. And that's is expanding globally and has a it's a bit of a spoiler. I was going to talk a bit more about that really, but a bit later. But that is what we would see as unique stock. But what I'm saying is there are high barriers to entry. It's doing something different to every other company in terms of its product, and that's within the mid 250. So, for example, if it was a staffing company, Hayes and Page Group, for example, they would be classified as having both exposed to the same theme, which is clearly employment and staffing. But a company like, say, for example, Games Workshop would be its own theme, and that would be a unique stock. But it doesn't only have a very strong business franchise and quality management. We'll also see their balance sheet strength and the possibility of being a FTSE 100 stock of the future. And of course, we would thank a stock like that by selling it, of course, once it got into the FTSE 100. But that is what we're trying to do, as I mentioned at the beginning. So we would take we'd characterize a certain number of stocks as unique stocks. And then another group of stocks we would classify as flex stocks. They'll be stocks where maybe the company's at a strategic crossroads. It's undergoing change. It might have new management. The supply of shares in the company might be reducing, possibly via buybacks. And I would say that the unique stocks and the flex stocks, they'll have quite different valuations. Probably the unique stocks will be a bit more expensive, but that will be reflecting the uniqueness really. And the flex stocks will have a lower valuation. And our portfolio will take what we see as attractively priced unique stocks, because it's no good if it's unique and incredibly expensive. It has to be attractively priced, and we put that together with attractively priced flex stocks to result in a portfolio of around 50 flex and unique stocks. And currently we have about 40% of the portfolio in unique stocks. Clearly, if there were more opportunities, we would flex that upwards. And it depends on the time in the market and where we see the most value, because many of the flex stocks are in old economy parts of the are in the old economy parts of the economy, and they can still be generating high amounts of cash, and they can actually be using new technology while being in an established part of the economy. So that's our unique and our flex stocks there. No diamond stocks at the moment to go with the symbol there, but there have been in the past in the index. I think no investment philosophy is complete without its selling discipline. And our favorite reason to sell is obviously if a company is promoted to the FTSE 100. When it is, we sell it, we wave it on with its packed lunch, and we look for the next opportunity, as I said. But the other reasons we might sell can be frequent or expensive acquisitions, and we look very keenly at the numbers around acquisitions. If they're just being used to hide the fact that there's very little organic growth, maybe in the story, then then we're very alive to that. We look at quality of accounting. We have 3 CFAs, some PhDs, and some accountants on the team. And so, it wouldn't be unusual to see us with a printout of an annual report underlining debits and credits. But yes, really, we do look very closely at the quality of accounting. If we feel a company is failing to respond to disruption, I talked about old economy companies which are reinventing themselves. But if they're not doing that, and they're not responding to the change in their business model or in their sector, then we will move out. We will obviously look at evaluation. When a company becomes no longer attractively priced, we'll sell as well. The company can be acquired, and at which point we would be obliged to sell. And also, if we see a deterioration in sustainability behaviours, where we see a risk that we're not willing to take from the point of view of governance, ESG more generally, then that could also be a reason to sell. And finally, if we see significant increases in industry capacity, huge numbers of new entrants successfully breaking in, prices, a bit of a price war going on, that could also be a reason to sell. So we get emails every day, inundated with emails telling us to buy because this is the cheapest relative to something in North Africa. Buy because this is the only version of this kind of dog food company relative to its comparable in the US. We have many reasons to buy. We're inundated with that kind of information, so it's very important for us to have this. It does look like a dartboard, but it certainly isn't. This approach, 9 reasons to sell, and I think it's very important for the team to have that, as a sort of a sticky note on the side of our computers saying, don't forget to sell. And I think that's a proven successful part of the investment process. I mentioned Games Workshop earlier, so we're going to have a little bit more on it now. This is something my colleague put together. He pulled out a headline from The Guardian where we talked about Games Workshop and their flagship product Warhammer, the game that is going to be there's an agreement in principle with Amazon to televise that. And to do some mini series and so on, and that will be down the line. But what that will do, we think, is unlock the Warhammer hobby to many millions, tens and hundreds of millions even of Prime members, and really bring the hobby to life again, and a hobby that's been really enduring for decades. And so an additional growth opportunity. This is a hobby that's fairly mature in the UK, but still growing in the US and beyond. In countries like China as well, and it's had a sales growth after a little bit of a near-death experience pre-2015, a sales growth of 20% CAGR since 2015. And you've got the current CEO, Kevin Rowntree, who has hugely transformed the business since he took over. There's huge intellectual property in this business as well, and I think you can see that in that little character on the right there. And I think, this is for us a significant, strong example of a unique stock. And again, with unique stocks, I think it's fair to say they're ones that are, because of their nature, are at more of a high risk of being acquired as well, and all the resultant returns that might come with that. So you've got your strong market position, your business franchise that's very strong as well, your scarcity value, the quality management, high returns, financing that growth internally. They talk about, it's a very good read, their annual report. They talk about they will create value by not destroying it for shareholders, keeping themselves firmly off our avoid list. They don't do acquisitions, and they're probably, it's, as I said, one of the better reads in terms of annual reports. Still kept them very, very slim, very strong balance sheet, and what we think could be a FTSE 100 stock of the future. So in conclusion, I think you could, perhaps you were surprised to see the mid 250, very difficult index to beat, but something that the trust has succeeded in doing since inception. I think that the negativity down at 11 times earnings that investors are showing towards UK mid caps is an investment opportunity. But what we are looking for, and what we're seeing actually as companies are reporting their numbers at the moment, is that you're seeing growth, you're seeing resilience, you're seeing very strong balance sheets. 80% of our holdings have net gearing of 1 times or less EBITDA, for example. So we think our holdings are very well positioned for what happens next, because you can see significant assets in distress, and our companies could make use of that in terms of doing acquisitions, in terms of taking market share. So we think we're very well positioned for what happens next. And there you've got on the fund summary showing you a bit on our discount, size of the fund, and other vital statistics. So I'm happy to go over to Alex, who's moderating Q&A, if he's ready.
Thanks, Jean, and thanks for taking time to give us this presentation today. To everybody present, I encourage you to continue sending in your questions using the Q&A tab in the right-hand corner of your screen. As the team go over the questions we've received so far, I want to point out that a recording of this presentation, together with the slides and the published Q&A, and also the most recent interims, will be accessible on the event page shortly after this call. I'd like to express my gratitude to everyone participating in the call for their active involvement in submitting questions. So Jean, you can see we've had some questions in already. We'll just kick off with the first one. So the low valuations of UK equities are starting to be recognised by companies and private equity, but M&A still seems a bit quiet. How do you see this evolving in the short midterm?
Yeah, I think there was a stage in the first quarter, I think I referred to, where it looked like private equity was really coming back in. But then we saw a stage where private equity was back in, but then changing its mind. And I think that, there's still a lot of dry powder out there. I think that where we have companies with high free cash flow yields, and we have a significant number of companies now in the UK universe, we were looking at them today, with free cash flow yields in excess of 12%. That's extremely interesting for private equity, especially if they're having to now put some debt into companies when they buy them. So I think, we will see, no doubt we will see more private equity bids, maybe as interest rates perhaps start to turn as well. It might be, in 6 months' time. But I'm confident that you can't see that sort of disparity of valuations of UK mid, and I'll have to say small caps as well, relative to their global comparisons, and in terms of the quality of the company. You can only expect to see more bid approaches, I think. And I mentioned already that last year was more of the year of the trade buyer, and this year, in the first quarter in particular, we saw. So last year was things like Micro Focus, Ted Baker, Brewin Dolphin, for example, but by RBC. This year, a bit more private equity getting involved in things like, for example, the Hut Group, approaching at Dignity, and Wood Group, for example, where I think the bid has gone away now. But that there's a bit more sort of private equity coming to life at the start of this year before sort of in this second quarter going a little bit more quiet.
You touched on interest rates in your answer there. I mean, how have companies in your portfolio coped with inflationary pressures and rising interest rates to date?
Yeah. So some companies have had a bit of a lag, but so they've not been able to put the pricing through straight away, but they've been able to enunciate that very early on. So maybe they've had contracts where they wanted to wait till getting the end to the end of the contract before repricing. In other cases, they're able to pass through, for example, energy price increases. It just depends on what kind of contracts they have. On the more consumer side, there seemed to be very little resistance to putting price rises through. Customers seem to expect it. But we're actually really coming out the other side now in terms of inflation pressures. And I think when we look at interest rates, I think when you've got 80% of the portfolio 1 times geared or less, it's much less worrying. So if you've got companies with net cash, actually, that's absolutely the right place to be. We have a significant number, something like 20 companies, which are actually net cash. So for them, interest rates are much less of an issue. And then in terms of if you look at different types of inflation, going back to inflation, things like house builders, the materials coming down in price now, a bit less pressure on labor and so on, has its own issues in terms of putting pricing through from here now potentially, but there's sort of a volume issue also, and I think that in terms of just the UK economy more generally, we keep hearing more resilient than expected is the general war cry, and it's probably worth mentioning PPI last week. Input PPI came out less high than expected, and I think some of the more dovish members of the MPC were saying that they maybe would expect not to need many more interest rate rises. But as we know, there are more than the couple of. There's not just the more dovish members, and far be it from me to forecast what they are going to do next. But it's certainly some inflation pressures easing now, and interest rates not such an issue when you don't have very many companies with a lot of debt.
And I guess linked to that and following on from that, I mean, what's your sort of take on UK sort of sliding into a longer recession?
I don't really see it. I think the animal spirits are very strong, and I see individual businesses being very strong. And just when I look around me, I see plenty of construction still, and it feels like despite what the media headlines might have you think, that there's the engine seems to be running really rather well. I think some of the PMI data were a little bit weaker than expected, and I have to acknowledge that yesterday, but nowhere near as weak as they were in Germany. And it feels as though the wheels are very much on in the kind of UK quoted stocks, and within UK industry more generally.
And we've got another question here about the large companies from London market going to the US, and the London Stock Exchange being portrayed as not being attractive relatively enough for new companies. Do you see a similar trend in FTSE 250? And if yes, does this create a challenge to continue finding opportunities?
Well, I think we need to tackle, first of all, how many companies have actually moved their listing from the UK to the US and then achieved a re-rating upwards. And I think we have a sample size of 2 or 3, something like that, on the research I've seen recently. Ferguson would be one that achieved a PE improvement of 1 times by moving its listing to the US. And it's, you had to get a 75% shareholder approval vote for that. It made sense for them because they had more than 50% of their revenues based in the US, and that's where their business is going. But it's a considerable amount of expense, and you might get a bit of an uplift to your share price when you first announce it, but it's far from a foregone conclusion that companies get re-rated upwards when the listing is moved to the US. I did see that Flutter The shares in Flutter responded well to an announcement that it would be moving its listing to the US, but I think it's far from an obvious thing to do. And then when you look at the mid 250 companies, I think the issue you've got there is you need to have a minimum of $1 billion, is according to my American colleagues who I checked with before I came on air, about $1 billion of free float in order for that to work in the US. And actually, well, some of them said $1 billion, some of them said 3 to 4 billion. So if it's 3 to 4, then that's pushing out the majority of the mid 250 constituents because it'd be too small. And then also, if you then look at it needs to have more than 50% of its revenue in the US as well, then that's really cutting that down. If you look at new listings, I think that some companies, there may be companies like Indivior, which is providing medicine, which is very much facing the heroin addiction issues in the US, and helping with those. That is one which, very much the business is focused on the US, and it would make sense for that one. But I think it's, examples saying that, many floats would be better off floating in the US. I think it has to have the business, good business reasons to do that, because it is a lot of hassle and you don't necessarily get a higher valuation. In sectors like construction, I would say, particularly, you might not get that higher valuation that you think you will. But, I expect it's something that will keep cropping up now and again. But equally, I think, that the government is also very aware of wanting to make the UK more attractive, and is due to make an announcement on that as well. So, I don't mean to say that the government is going to solve it, but I think that the market clears, and that London is still very much a centre of a very attractive place to float as a mid-cap listed company, particularly if you're international and don't have more than 50% of your revenues in the US.
So on that note, Jean, how do UK equities compare with global equities, and what opportunities do you specifically see for UK mid-caps versus sort of global SMID?
Yeah. Well, again, I've talked about and I showed the graph showing the cheapness of UK equities. And I think what you're seeing actually, and what's quite scary actually, is the lack of breadth in terms of the numbers of companies whose share prices have actually gone up in the US. And I think that is what makes me quite nervous about the US. And a colleague of mine used this analogy, and forgive me if it's a bit graphic, but he was saying, if you're going to buy shares, if you're going to jump out of a window, would you rather jump out of a 5th floor window or a 1st floor window, with a crash pad underneath? And I think, if you're investing in the UK, then you've got that crash pad underneath. And if you're investing in UK SMID, that cushion of valuation. And if you're investing in UK SMID or particularly mid caps, then, relative to their history, they're looking extremely cheap on a 5-year view. And I think, you're still seeing savings which haven't been depleted yet in the UK, for example, versus very close to being depleted in the US. I think there's a forecast of September and October, all those excess savings being depleted. And in the EU, economists whose papers I was reading this weekend were saying they feel that the consumer surplus that was saved during the pandemic has already been spent there. And so I think, not just talking about consumer stocks, but more generally that the UK is in a stronger position, both from in many ways, an economic point of view, and then also from a valuation point of view. And I can't, really stress enough the importance of the price you pay when you buy a stock or into a market. And so you have, the protection if you buy into the UK, and in particular UK mid, which has been, I think, sold out of for, with the flight to liquidity. And that's why you're seeing like that bunched few stocks, and the US outperforming with that small handful of stocks, which you'll all be familiar with, versus a much more well-diversified number of stocks which have performed in the UK, but still remain cheap because they've been, earnings have been upgraded. There's the same amount of upgrades as downgrades actually in the mid-cap universe, which is a comfortable place to be at this point in time, I feel.
And I think we've got time for one last question, which I think for any active manager would be seen as a gift. So thank you for this one. Why should I invest in an investment trust versus a FTSE 250 ETF?
Well, if you look at the investment trust performance, you can see that it's better than the ETF. I think if you have any interest in active management, you will, I haven't put in a section on sustainability in the presentation here, but you'll see that we speak to company management and we go for better outcomes. You're able to avoid what we see as the booby traps. We have our stocks to avoid, but we also have the overly expensive stocks which we don't buy. So I think, for better returns really is why you would do that. I mean, I don't know what sort of fee you might get charged on an ETF, and it's not my area of expertise, but I think you should be able to get a better return really, and that would be the reason you do it, and that would be after fees. So I think that's a good question. I think if you're looking at investment trust versus open-ended as well, certainly the gearing seems to enhance returns, and also there are no forced flows in an investment trust, and that's the beauty of it really. So you can be a bit more patient with your holdings and much more in control of your own destiny as a fund manager, not being sort of hit by an onslaught of inflows and outflows. So yeah, for many reasons you'd expect me to say, that's why I'd go for the actively managed investment trust.
And also, you can't buy an ETF on a 14% discount.
Well, yeah, I started by talking about the discount, but yeah, you can't buy it. Exactly right, Alex. Thanks for pointing that out.
Great. Jean, thank you very much for your presentation this afternoon. And to all investors, we kindly request you keep this session open, as we'll be automatically redirecting you to a feedback form. The insights from this form will greatly assist the management team in understanding your perspectives and expectations more clearly. We sincerely appreciate your participation in today's presentation, and we'll now bring this session to a close. Good afternoon, and thank you for tuning in.